Is Disney finally cheap enough for us retail investors to buy? We know this stock has been priced expensively over the past few years, despite all the lockdowns preventing park visits. However, the stock has dropped about 35% since the 2021 highs. And so we have to ask ourselves, is Disney a worthy addition to our portfolio? Will this earnings release prop the stock higher, or will the stock begin to decline from these levels? Keep watching to find out, as we'll be talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, today we're going to take a look at Disney's Q1 2020 results, where we'll do a deep analysis into the financials. We'll take a look at the technical setups that are currently in play, and then we'll conclude with a valuation of the business to see whether or not this is something we as retail investors should be adding to our portfolios or not. And if you enjoy the analysis and the investing perspective, please like and consider subscribing for more of this content. So just before we jump into the earnings released, as always, we're going to take a quick look at the stock to see how it has performed over the last few years to get an idea of where we're likely going to be heading from here. And as you can see, the stock has had a slow and gradual climb higher, and it has ultimately dropped from this $200 price range all the way down to about $140, $130 per share. And that represents about a 35% decline just since about March of 2021. And that's what this green box indicates right here. This is our support, okay? We can see we have support here. It's held as resistance previously. It's held as support and support again. So really, this is a confirmed box. It shows us exactly where there is support, propping the stock higher. Now, if we want to look on the opposite spectrum, we have resistance, okay? Clearly in this 150 range, we've had resistance. We broke through there before. And so once we break through, we want to see this area hold as support. And so that's exactly what you see here. A nice wick off these levels. And again, once it's come in here, it's acted as resistance. So we're at some interesting levels at this current point in time. And that's what these red boxes indicate. These are points of resistance. Green boxes are the points of support. That being said, let's take a look at where we are after hours. This stock just reported earnings at the time of this recording. So as you can see here, at about 4 p.m. today, this stock ripped up from 147 all the way up to this 160 price range. Has since fell just slightly, but that's what you can expect on after hours market movement. But nevertheless, we're back into this red box. So we know that there's going to be some form of resistance in this area. If we can push through these levels here in this 160 range, yeah, let's look to see if this stock can get all the way up and up into these 170 price range, and then we'll see if they can trend in between here before pushing higher again. But the market clearly has liked what Disney has reported for these Q1 2022 earnings. Now, that being said, we as retail investors must always keep in mind that in order to be profitable year over year, we have to be able to buy businesses at a margin of safety when their valuations are mispriced. And to do that, we have to make sure we're not buying shares when they're priced expensively. So is Disney cheap? Is it expensive? That's what we're going to find out. But let's see what exactly the market liked about Disney's results in this most recent earnings report. Okay, so Disney came in with their Q1 2022 earnings release and reported revenue of $21.82 billion. This beat expectations of $20.96 billion, and actually year over year is an increase of 34% in terms of their revenue growth. Earnings per share is not much different. They came in at $1.06 per share. They beat expectations of 57 cents, which proves their ability to grow and expand on revenues and earnings. Now, this next section here, the highlights, is what I want to bring your attention to, and is really what is key for Disney going forward. Disney was able to increase their subscribers for their Disney Plus subscription by 11.8 million users this past quarter. So they are now at about 200 million users globally, each paying a subscription fee, bringing in recurring revenues for Disney. The key here is their average revenues per users actually increased to $6.68 versus the $5.80 previously. This is great growth, and if Disney can continue to grow their average revenue per user, the fundamentals will explode like they have this earnings release. However, if that falls, this is where we'll see the fundamentals start to drag, and that's exactly why this is a key focal point for Disney going forward. In terms of their outlook, they didn't really talk too much about this in their earnings release, but we know that this depends on the situation in terms of lockdowns, in terms of the parks and experiences shutting down, because we know this is a huge factor and a huge component of Disney's earnings is their experiences, their ability to bring people to their parks, ride on the roller coaster, spend a bunch of money. And that's why the lockdowns and the continued improvement in the global situation at this point in time is key for Disney as well. So we've talked about the press release. We know top and bottom line have grown significantly, but what about the margins and their cash flows? That's what we'll get into now. So starting with the revenue, we know that they have about $21.8 billion in revenue for this past quarter. This is up again, that 34% year over year from this $16 billion figure. Now, what immediately rubs me the wrong way is their extremely high costs and expenses on their revenue. They came in with $19.6 billion in costs and expenses on the $21 billion, or let's say $22 billion in revenue. This means that Disney has low margins. And that's not the greatest thing for investors or potential investors to see, is a business with very thin margins. Now, we know that they have some other expenses. Anyways, we get down to this net income from operations, and we get to $1.2 billion worth of net income. And despite their low margins, this was able to significantly grow from a year ago where they were only at about $30 million. Now, take this growth with a grain of salt, because we do know that there was massive lockdowns. The parks and recreations were closed. People were not allowed to visit the parks even if they wanted to, and that was a significant drag on their fundamentals. However, this past quarter, that's not the case. They had many visitors at the parks, along with growth in their services, and that's why we'll see that their net income from operations has increased by such a significant figure. Now, let's quickly run through the balance sheets. Now, we can see cash is relatively flat year over year, and that's what leads us to total current assets being relatively flat as well year over year. They have some other assets. That leads us with total assets of about $200 billion. Now, let's look at the liability side of the equation. The first thing I look for is their debt. So they have current debt of $6.7 billion worth, and then they also have long-term debt of $47 billion worth. Now, if we add those two figures together, let's just ballpark it and say it's about $55 billion worth of debt. The first thing I want to know is, can their current assets pay off the debt right now to know if their debt is even a problem for them? And frankly, their debt, if we say $55 billion worth of debt, they only have about $33 billion worth of total current assets. So no, while this debt is not a big problem for them on their $200 billion of total assets, their current assets aren't able to afford the debt. And that's why, for me, the balance sheet is just not up to my standards of investable businesses. Now, let's get to what I call the most important statement, which is the cash flow statement. We pull down that $1.2 billion in net income. We add back in our depreciation, amortization, our other non-cash costs, and we get down to this figure here, $200 million worth of cash outflows for this past quarter. This is down actually 74% year over year from this $75 million back in their 2021 fiscal year. And that's the ugly part of Disney's financials at this current point in time. Not only are their margins low, but their free cash flows are decreasing despite their top and bottom line growth. And this is not what I want to see as a business I'm looking to invest in, especially since they're not able to reward me as a shareholder like they were previously, where we can see last year they were paying down some debt. This year, they're not able to do that. In fact, they had to take on some more debt. So overall, that is the biggest issue I have with Disney's fundamentals. Now, I don't think it would be wise for us to use this past quarter's free cash flow metrics as a valuation, because Disney is still going through some pains at the moment. So let's try to find out what free cash flow metrics we can use for Disney's valuation. All right, so before we get into the calculator, let's figure out what free cash flow metrics we should be putting into our calculator when we think about what Disney can get back to in terms of their free cash flows. So what do I mean by this? Well, as we can see historically over the past 10 years, they've been trading at, from $6 billion worth of free cash flows all the way up to $9 to $10 billion worth of free cash flows at the end of the year. So we're currently sitting at this $1 billion free cash flow number. If we are able to increase that free cash flow number back up to, let's say, even half of what it was before, let's say $4 to $5 billion, then we should see a sizable return. So let's see, with our calculator, using that $5 billion worth of cash flows, what Disney should be worth. So if we put in $5 billion worth with a 10% expected return on investment, Disney has cut their dividend, but if we assume that they will bring it back in the future, we'll also add that into our calculation. And so for Disney, let's say they will grow at about 7% for the next 5 years, and then 5% for the 5 years after that. With a 20 PE multiple, they should be priced at about $107 billion. Now, that's a conservative estimate. If we say that Disney can now start to grow at, let's say, 13% for the first 5 years, and after that they're growing at about 8% with a 25 PE multiple, they should be priced, let's say, $175 billion. And finally, let's look at the worst case scenario. Let's say for the first 5 years, they grow at 5%, and for the next 5 years, they grow at about 4%. With a 15 terminal PE, we're looking at a valuation of $81 billion. Disney is currently trading at a market cap of $277 billion. So what does that tell us? That tells us Disney is massively overpriced at this current point in time. Yes, they are struggling with the global impacts over the past few years, but in terms of a return to value, we're actually overpaying, even if they are to return to $5 billion in free cash flow per year. However, this number is skewed due to our required return. If we bring this down to, let's say, 7% return, yeah, we can say that for a 7% return, they are fairly valued if they can get back to this $5 billion free cash flow number with 13% growth over the next few years. And if you believe this is something that's completely achievable for a business like Disney, then yes, if you expect a 7% return on your investment, this might be a great addition to your portfolio. That being said, I look for higher rates of return, so I will not be purchasing shares of Disney at this current point in time. But if you're looking for higher rates of return, this may be a stock to trade instead, as we can still capitalize on the rebound, and that's really the risk and reward for Disney. So that's my analysis of Disney's Q1 2022 earnings. If you made it to this part of the video, thank you for watching. I'm wishing you financial success. And with that being said, I'll see you on the next one.